Hello and welcome to Risk at Work, Risk Connect's educational web series. I'm Scott Fenstermaker. I'm the head of digital marketing at Risk Connect. Today, we're going to be talking about how fragile is your risk process. We may not appreciate that uncertainty can impact us in different ways depending on how our organizations or how our projects or how our systems are constructed. And it's about time that we took a little bit more time to appreciate the different ways that we can set up our organizations such that uncertainty impacts us in the most optimum way. Uh, Very recently, banking disruptions were in the news again and are probably going to be continue to be for a little while. And these are banks that, for all we know, had risk departments that were looking after things. They were doing so very competently, and yet the troubles that befell them were very hard to see in advance. So we have to ask ourselves, if risk events are not by nature predictable, which we know that they aren't, and the impacts are hard to see and hard to judge, what is it that we can see that is predictable and that is it has us gives us some kind of predictive ability to be able to position ourselves to be resilient? And we have a wonderful guest to speak with us about that today. I'm going to be introducing our guest, Jason Mefford, welcoming him back to the web series. Jason has previously held executive roles as Chief Audit Executive, Chief Risk Officer, Chief Ethics and Compliance Officer, Chief just about everything having to do with risk at one point or another. He's the author of Risk-Based Internal Auditing. He's a contributing author to the OSIG GRC Capability Model 3.0 and Sawyer's Internal Auditing version 7. He's the host of 2 podcasts, including Jammin' with Jason, which I always love to say at the introduction to a podcast, and we are very fortunate to have him back with us today. How you doing this morning, Jason?
I'm doing good, and I'm glad to be back jamming with you, Scott.
I'm
I
glad
just
to
love
be
that word.
back,
Every
champ. I know.
every time I hear that, I think of Bob Marley and reggae too, which always makes me happy. So
Well, now
we
it
be
makes me happy too.
jamming.
We be jamming. Well, now it's making me happy as well. So I'm very glad to hear that. So this is going to be a little bit different format for Risk at Work. Normally we start with the guest and do kind of a presentation model and a little bit of Q&A at the end. This particular time, I'm looking forward to this discussion, not only because it's going to be more of a free-form discussion between me and Jason, but because I actually get the opportunity to introduce some material this time. I'm going to introduce a couple of concepts at the beginning here that come from a white paper that I wrote about a year ago called The Hunt for Hidden Risks, which is available at fine Risk Connect websites everywhere. That goes into the topic of fragility. Fragility is kind of a cousin of resilience, but it's the reciprocal concept, right? And it's a concept that doesn't get enough study. It doesn't get enough focus. We focus on being resilient, which we absolutely should be, but there are elements of what it means to be unresilient, what it means to be fragile, that one can look for and that have predictive value and that one can go after when one does not necessarily know what impacts are going to befall them, or what events are going to befall them, or what impacts they will have. So I'm going to take a couple of minutes here and talk a little bit about some concepts. Now, one concept that we're all familiar with because we've been on the web series before, because we're familiar with OSIG and so forth, is the concept of uncertainty. The OSIG's definition, Jason, the definition of risk according to OSIG is what? Remind me again.
The effect of uncertainty on achieving objectives.
The effect of uncertainty on achieving objectives. So we all are familiar with this concept. As we go through into this discussion, there are some synonyms that we can use for talking about uncertainty. We can talk about randomness, we can talk about entropy, we can talk about luck. We're essentially talking about the same thing. But the concept that I like actually better than uncertainty is volatility. And it's for the image that it conjures up. When you think about uncertainty, it kind of conjures the image of anything could happen, right? You're just uncertain about it. You don't know what's going to happen. Volatility is a little bit more robust a concept for this discussion because it conjures up the image of some kind of expected outcome, some kind of average, and then a deviation from that expectation. And sometimes the deviations can be large, sometimes they can be small, but we're basically talking about bouncing around an expected outcome, which is going to be helpful to us as we discuss this. Now, if it's true that volatility just means bouncing around a certain predicted outcome, sometimes it's favorable, sometimes it's unfavorable. The question is, why is it that it never feels favorable, right? If luck can be either good or bad, then how come volatility always feels like a drag to us? How come it always seems like an encumbrance of some kind? You hear about companies having cyber events all the time, but you never hear about a cyber related windfall, do you? It never comes out in the wash. You never go into work one day and some hacker has given you a whole bunch of money, right? How come these things never seem equal, right? And our intuitions are correct on this. While the events, when we're talking about the separation of events and impacts, while events can be random and can sometimes be favorable and sometimes unfavorable, the impacts to us more frequently than not are asymmetric. When we experience favorability in an event, it's typically a modest favorability. It can be more frequent, but it's typically modest. It's typically often baked into the assumptions, baked into the cost of doing business. But when we experience unfavorable outcomes, the impact to us, while it might be less frequent, is typically much more pronounced with much more of a downside. And it turns out that the reasons for that, the things about our projects or our companies or any kind of complex system that makes it that way, that makes it uneven like that, are predictable. These characteristics can be sought out, and we're going to talk about that today. But we have an inkling as to why these are, right? We see it and instinctively know that when companies get or projects get scaled up, when they get more interdependent, when they get more complex, they tend to run into more problems being predictable. They tend to rely more upon a concept that I use called cascading miracles, right? Where more and more often, every single little thing has to go right all of the time in order to be on time and under budget. And you just keep adding more and more of those little things that have to go right. Why is this? Why is this asymmetric like this? The reason why, I believe, is that for many, many years, back to the age of Deming, we assume that when we get um, the advantages of more advanced businesses like size or interconnectedness or efficiency, that we get those trade-offs for nothing. That all things being equal, it's just better to be part of a bigger company than a smaller company. You have more options. It's better to be part of a more efficient than a less efficient company, more integrated than a less integrated company. And that can be true, and that can be frequently true. But what we assume are advantages that we are getting for free when we optimize, for example, are actually, we're not getting anything for free. Everything in life is a trade-off, and we're just ignoring the downside of the trade-off because it's infrequent. So what we do when let's say we make our company a little bit more efficient, is we are trading a modest advantage that happens frequently and that's obvious that we can see for an infrequent disadvantage lots of times when we walk into work one day and the assumptions that we made are no longer holding. This is what this looks like on a chart. This is what we call an asymmetric trade-off. And you can see exactly how this works, right? So this is a very simplistic representation, but you picture that curve, that impact curve intersecting the stressor line there, and to the left of it, you get an advantage. You get a tiny little bit of advantage. But if on the rare occasions where it moves to the right, where you experience some volatility, you get a infrequent downside, and that downside tends to be much more pronounced. Let me give you an example of this. This is an example that I use when I talk to startup founders all the time. The idea of an efficiency consultant, like coming in, and let's say that you have two suppliers for a component, supplier X and supplier Y. Supplier X is a little bit cheaper, supplier Y is a little bit more expensive. They both provide you the same component, and either one of them on their own could supply you with 100% of the components that you need. First thing you do as an efficiency consultant, what do? You cut out supplier Y, the more expensive one, because you don't need them, right? You consolidate everything with supplier X and you save a little bit of money every day, right? There's a cost savings because they're less expensive. So let's say you save the company $5 a day. So yesterday is a $5 savings, today is $5 savings, tomorrow is a $5 savings, and it adds up. And your genius, you look like a genius in direct proportion to how much of that little advantage you add up day after day. Until one day you walk in and there's a fault with supplier X and they can't give you the component anymore. You have to shut down and you don't have an immediate backup of supplier Y. You have to stop until you can onboard them or a replacement or something like that. And the stoppage costs you multiple times the grand total of all of the cost effectiveness that we were saving day after day after day. That is the kind of trade-off that we're talking about here. And that's what we call a fragile trade-off by definition. So fragile has a robust definition. Fragility means you have more to lose than to gain with additional volatility. And it's represented by that kind of impact curve right there. So you see that zero volatility is represented by X on the graph there. If you stay at X and there's no volatility, you're not moving around, you have a little bit of an impact, but not much. If you move left and right, if you introduce volatility, you might get some favorability, you might get some unfavorability, but the unfavorability is always greater than the favorability, and so always wipes it out. So all things being equal, you would rather have zero volatility than a lot of volatility, because volatility can only hurt you. It sounds like a tautology. That's actually a pretty robust definition. And once you start seeing this, you see this everywhere, right? A great example of this is the airline industry. Airlines are, you notice that when you get on a flight and you land somewhere, when it's early, on the occasions when it's early, how early is it? It's like 10 minutes early, right? 15 minutes early. Any earlier than that, and it actually causes more confusion because you have to switch gates and stuff like that. When it's late, when it's on the other side, how late can it be? If you really, with 3 hours, 5 hours, plane doesn't take off, it can be almost infinitely bad, right? The reason is because travel times can't inherently be negative. You are bounded on the one side. So when randomness gets into that system, it has no place to go except to spill out on the negative side. Lots of systems are like this. And the more complex the system, the more that curve is pronounced like that, what we would call a fragility curve. All right. The telltale sign of a fragile system, any kind of complex system, is again the impacts don't just get linearly bigger with the size of the stressor, they get bigger in an accelerating way. You get that exponential curve down like that. That is the telltale sign. That's what makes the definition work. That's why you have more to do than less to do with the volatility. And that characteristic opens the door into what we're going to be looking for in order to be able to identify these areas, right? So, example of this, let's say that I have a platform that's 3 feet off the ground, and I ask you to stand on that platform and jump to the ground off of 3 feet. What's the impact to your body from doing that? It's going to be, unless you're like 80 or 90 years old, it's going to be essentially nothing. You're going to walk away from it, right? If I tell you to get back up there and do that 9 more times, so you've jumped off 10 times, still virtually nothing. You're walking off that, right? Now, I make you a trade. I say, instead of jumping 10 times off of a 3-foot platform, I got this 30-foot platform up there. I want you to jump off that once. The damage to your body doing that is much more than 10 times the 3-foot platform, right? The damage to your body from that 30-foot platform is infinite, which means that when I'm adding feet to the platform, I'm not just adding the same amount of stress to your body. The stress that I am adding to your body is going up. The marginal stress is going up with each individual foot. This is a characteristic of any system that's approaching the amount of volatility that it can hold. When you look at metallurgy, there's something called a stress strain curve, which happens when a piece of metal is getting close to the amount of weight that it can handle. And it stands up, it stands up, it stands up, and then very suddenly it breaks. It's the same idea, right? We are getting closer to the amount of volatility that we can take. As we get closer, we get in trouble. And the significance of this, the way that this is curved, is, or one significance of it is that it makes it very, very hard to detect impacts as they're about to happen, because it takes you a while to feel it. The way the curve is structured, by the time you actually feel that you're undergoing an impact, you are much closer to the cliff than you think you are. It's 1 foot off the ground, then 2 feet off the ground, then 3 feet off the ground. You feel nothing. And then 4 feet off the ground, you start to feel something. 5 feet off the ground, you're breaking stuff. That's how this works. And that's why fragility is so dangerous. Okay. Couple last points. I keep mentioning that there are characteristics that we can look at to identify fragile systems so that we can go about trying to make them less fragile. This is a list that I keep. This is my list. It's part of the white paper that I referenced. And this is based off of Nassim Taleb's, as is the definition, book, Anti-Fragile. And I find it a very insightful book. And it's based off of that. So I've taken this and I've made this list myself, and I've been modifying this over time for about 10 years or so to try and capture everything that I wanted to capture. I'm still kind of modifying this, but I'll give you everything that I have so far. So factors that increase fragility. What increases fragility? What are we looking out for in our organizations, in our projects, in our systems, processes, and in our risk processes that we're just going to talk about right now? Number one, compounding impacts. So you have data points that aren't siloed off themselves. Something that happens to one data point can ripple out to the data points around it and affect those, right? Banking has been in the news recently. That was a compound effect. There were some, in one particular case, there were some withdrawals at the top in the high deposit area that who then rippled out to other people who wanted to withdraw. In fact, created a run on the bank. A run on the bank is a compound effect of what we're talking about. Two, big expensive mistakes as opposed to small manageable mistakes. I used to work for a company when I was first out of college that thought it was crucial that they get into the satellite phone market in the late 90s, early 2000s, right? And they invested all their cash, all their leverage that they had on this particular system, and came up with a satellite system that everybody uses today, right? You had to use one of those brick phones, satellite brick phones. It cost $5 a minute, and you couldn't use it indoors. This is what they thought was going to be their grand investment. And you'd think that they'd be able to pilot at least some of those dynamics before shooting stuff into space, right? Three, scale. Everybody thinks that a bigger company is a better company because you can push stuff around, you have more options. True, but you also, the trade-off for that is squeezes, right? Big companies, if they want to sell off an entire class of asset that they have, right, can't do that without affecting the entire market price of that asset and therefore taking a haircut. The little things that you want to change end up having enormous impacts, and that's a downside to scale that you have to be careful of. Single points of failure or over optimization. We talked about that with the consultant. Misaligned objectives. So this is a skin in the game principle, right? The people making the decisions don't have the same thing to gain or to lose as the people who are affected by decisions. We've had a hazardous material train derailment recently that was in the news. And when that happens, I'll just ask this hypothetically or rhetorically, how many times do you hear about hazardous material derailments happening in wealthier neighborhoods as opposed to not as wealthy neighborhoods? I'll just give that some food for thought about skin in the game. Top-down controlled planning and or over-reliance on forecasting. So I get crap for this one because everybody was like, well, we have this great system, everything is controlled, and we make all our decisions centrally. We centralized everything for all of this efficiency. It turns out, all things being equal, and I'm happy to be challenged on this, it is more robust, it is less fragile, all things being equal, to push out decision-making autonomy into more localized structures, business units as opposed to businesses, for example. It just reacts to, that kind of system reacts to volatility better because there's less overt interconnectedness and so forth. A good model to think of with that is the the communist economic system versus the free market system. The central planning, which was supposed to be the main feature of communist economics, couldn't keep up with the realities of what you needed to control something that expansive. Nothing can. Um, uh, Operating incongruently with your public commitments or your brand promise. If you promise food delivered in 30 minutes or less, you are fragile to late deliveries. That's true. And time itself. If you haven't checked your smoke detectors in years, then you're going to be fragile to fires. So final thoughts, and then we'll move this along. Number one, you can have differing amounts of fragility in different domains or to different strategic objectives. There are companies, if you think about a startup that has VC investment, they might be very fragile to growth. They have lots of growth that they need to achieve, but not fragile to profitability because they're not caring about that yet. All companies are different in this way. Most fragilities are hidden because of their infrequency. We assume we're getting something for nothing, and we just ignore the possible trade-offs. So we must seek out the qualities on that list before and the telltale signs of fragility in order to be able to have any kind of impact on positioning our organization optimally. And this is now what I want to get to, and we're going to bring in Jason to talk about more robustly about this. But risk processes, risk frameworks, risk controls, they're all subject to these same principles. They're all subject to fragility. They can all have trade-offs to them that nobody has anticipated. And so with that, I would like to welcome Jason and talk a little bit more. And the first thing that I would like to do is I would like to ask Jason a little bit about where he has seen some of these principles happen in his own personal experience. Jason, what do you think?
Yeah, well, it's going to be interesting because I think it's, a lot of the stuff that you kind of set people up with. Now let's go through and we'll talk more about some of the things of actually where the rubber hits the road on it as well, if you want to
Sure.
say, right? Because as you're going through it and talking about this, I think hopefully what we can do from the discussion today is people might have started off and going, oh, Scott, it's all theoretical, blah, 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 right? This will never
Right.
happen. Well, hopefully from our discussion today, this is going to flip people upside down and have them start to realize that you are much more fragile than you realize. And in fact, thinking that you're controlling everything, thinking that you have all of this stuff in place is probably making you much more fragile than you actually realize. And so we're going to talk about some real life examples. I will put in, some of my own experience as well. I'm going to use some language that might be slightly different from what you did, because again, everybody kind of learns a little bit differently. And so, again, the whole idea is we're going to kind of shock you. So set aside some of the preconceived notions that you have about how good of a risk manager you are and you've got everything under control. Just put that to the side for a few minutes and listen to what we're going to be talking about from a really open mind, because when you do that, you're going to walk away and you're actually going to see some places where you're much more vulnerable than you realize. All right, so I asked you to kind of set aside stuff. So now let's just start using some different terms and kind of Jason speak to get you thinking. So Scott brought up, I guess the first one here that as we talk about why organizations become fragile, one is what I call squeezing pennies and milking value. Okay. And I've got a penny right here on my desk, right? That kind of helps remind me of some of this stuff. And I used to milk cows when I was a little kid. We had cows on our farm. So what does that mean? Well, a lot of times it means that you're taking on too much leverage. And so some examples are obviously the more leverage you take on, when things go your way, you make more money. The problem is if you've got a lot of leverage, the minute that leverage switches to the other side, that's when you become extremely fragile. And that was that down arrows that Scott was kind of showing on there. So how does this show up? Well, for example, just-in-time inventory is one of those things, right? It's a great opportunity for you to be able to maximize what's on your balance sheet or not on your balance sheet because you're just getting in the inventory just exactly when you need it. But any hiccup and you're screwed. Okay. And Scott brought up the whole idea about, cost efficiency. I got a real life story for you folks, right? Is that we would, one of the food companies I was at, we would have customers all the time that would try to nickel and dime us. And they'd come back and they'd say, well, you know what? Your competitor can do it for a penny a pound cheaper than you can. Fine. Go with that competitor. But we can guarantee you that our on time delivery, our customer service, everything else is worth way more than the penny. A lot of companies would say, well, okay, we're going to go take the penny. Guess what happened 3 to 6 months later? They'd come back screaming because that other person that they were hiring just because of cost, their whole factory was shut down, right? And so anything that you think that you're going to make up on trying to squeeze pennies or milk value, you will invariably give it back, right? So if you're doing that, you're going to give it back, okay? Financial and accounting decisions are a big one. A lot of companies run their businesses based on how good it's going to look accounting and financially, right? And so, how is this going to affect my ratios? How, should I set up my supply model in such a way so it doesn't look like I have any assets? I lease everything. I have just in time inventory. I have no assets. And look at all this money that I'm making. It might look great to the street, right? But the minute that you start making business decisions for accounting reasons, you are becoming very fragile. Okay, I'm going to say that again because a lot of people don't get this, right? And as a CPA, I get it, right? I understand why companies want to build their business around the way things are accounted for. But if you do that, you're playing with fire. Okay. And this has happened in some of the bank failures and other things. A lot of accounting is not real life, is not real life. And so the fact that you choose to, or the accounting rules tell you that you have to account for things in a certain way has no bearing on the reality of your financial situation. So again, another real life situation. Accounting said that we had to market these derivatives mark to market. Okay, fine. So every day, right, you have to mark it up, mark it down. Now that's not real money unless you actually close them out on the day of, right? Now it just so happened one time, get this, the last week of our fiscal year, the market took a dump, right? So we had a huge write down on some of our investments because we had to mark them to market, which meant we were out of compliance on some of our debt covenants. What happened the next week? That went right back up, right? So it was a point in time snapshot, right? And we didn't want to run our business. Now, it just happened that that was the way it was. Were we fine? Absolutely. We had plenty of cash. We were okay, right? So don't make decisions based on how things are accounted for. Maximizing a temporary advantage with a long-term solution is one that a lot of companies find themselves in. And so we've got an example of the A380 plane. One of my friends loves airplanes. And so when he comes over, we talk about airplanes often. And I used to fly, Airbus made the 380. It's a huge, biggest commercial airliner ever. I mean, these things are gargantuan. I used to fly on them all the time when I was going over to the Middle East because a lot of the Middle Eastern airlines were buying them up like crazy because you can put, I don't know, a lot more people on them, right? So the idea was load up the plane, send it over so you're getting more revenue per person on the plane, right? And what's interesting is my friend was over and we were talking because I live near LA and out in the Mojave Desert, just outside of LA, in a place called Mojave. There is a huge, it's not a huge airport, but it's a huge airfield. And what it is that's where a lot of the commercial airline planes go to die. That is a cemetery for a lot of these planes. They'll fly them out to Mojave. And so when you drive by on the freeway, you see all these planes. And my friend was talking about the A380s. He's like, man, that the place is just full of A380s. And I'm like, why? They're new planes. What's going on? And we started talking about it. And he's like, do you know how much it costs to fly one of those things? And so the problem was with the pandemic and everything else, with capacity going down, the airlines couldn't fill the planes. It was more expensive for them to fly those planes. And so they decided to take a perfectly good airplane and put it to rot out in the desert, right? So again, there were lots of companies that were trying to take advantage of what really was a temporary advantage by taking a long-term position by buying all these huge aircrafts. And now almost nobody will fly them, right? So it's a real life example that happens all the time. Thinking we have control, right? The more you think you have control, the more you are controlled. Yes, the better you are at managing some of these small, high frequency items. But there's also the opportunity loss that people don't think about. A lot of times, I mean, small companies make a lot more money than big companies do. Now, small companies can also lose a lot more money than big companies do as well, right? And why is there the difference there? Because again, larger companies typically have a lot more controls, a lot more overhead, and they don't make as many higher risk decisions, right? Because they're so worried about the loss that they don't want to make a mistake. And so I know, Scott, when you were kind of talking at the beginning, part of it was, how come it's always these big things that we see? How come
Hmm.
we're always worried about the big things? Because human nature, we are concerned about making mistakes
Yeah. Yeah. You've talked about that several times about
several times.
the,
Three to one
yes.
ratio. We will identify or see negativity three times more than we will see the positive. It
Yes.
doesn't mean the positive isn't happening. It just means we're not looking at it. And so what ends up happening is for every one of these large fragility downturns, there is a possibility for a large upturn.
Hmm.
But nobody's looking for those. Nobody's focusing on those. When those things happen, we ignore them, right?
Yep.
And so again, we'll get into maybe some more control, but you talked about the weird incentives again, and I've got lots of stories about that. That anytime you have different people in your organization that are incentivized in different ways, right? Now, all of a sudden, you have effectively people within your organization wanting to make different decisions based on their bonus.
Yep.
And so I'm sure I've shared this before on one of them. I mean, we had one issue where our operations managers wanted to hedge 100% of our natural gas. Why? Because they budgeted a higher rate than what they could buy it for now. So they're like, screw it. I'm going to be 50 cents ahead on my budget. I don't even have to do a damn thing.
Right.
And I'm going to make 50 cents, right, on millions and millions of these things, right? So that's how much is that in my bonus? Of course, I want to do that. Well, for the total company, though, didn't make a lot of sense, right? And so again, we had that push and pull because the incentives were not aligned. Now we've got the not appreciating the downside, the over optimism, which again is my mother always told me I'm a special boy. And because I'm special, that means bad things don't happen to me. They happen to everybody else, right?
Hmm.
And again, that's a natural human cognitive bias, is to believe that we are so different or we're better or we can control things better than other people, that these things never happen to us. And so we're
Hmm.
always over optimistic. I mean, you talked about startup companies too, as you were talking, and I did a bunch of work with startup companies, and there's the hockey stick. It's like,
Hmm.
I mean, you give me any financial projection for a startup company, it's the hockey stick.
Yeah, sure.
Oh man, 3 months and then revenue is just going to go through the roof, right? And
Right.
it's like,
No
well, no,
research, no MVP, but boy, those
no,
financial
no.
projections are great. Yeah, yeah,
Yeah,
yeah.
yeah,
I've
yeah,
been
yeah. And I used to tell them, I'm like, no, it is a hockey stick. You just got the stick turned the wrong
turned the
way.
wrong way.
Right. You're not going to get those increased revenues in 3 months. They're gonna be out a little ways longer. But anyway.
That's right.
And then what I like to do, most of us wear glasses, and you understand the concept of rose-colored glasses, but this is real, folks, is a lot of times we forget history and we think that everything that is going on right now is going to be this way forever. Okay. And the problem is because in our limited remembrance as humans is very short windows. We think in terms of quarters or years, right? The older I get, right, you have to start thinking more in decades, centuries, because sometimes, we look at things like you made reference to some of the bank failure and the issues, right? And a
Hmm.
lot of people will say, well, it's been forever since we had bank failures, so that's not even a consideration anymore.
Right. Right.
Hello. That's always going to be a consideration, folks, right? And so don't think that just because in the recent past, things haven't happened this way, it doesn't mean that they're not going to happen. There will be bank failures. There will be a lot more bank failures. Any regulation, cannot help some of these things. And in fact, it's a great. I love the movie "It's a Wonderful Life."
Hmm.
That's just Jimmy Stewart. It's George Bailey. you know, but it shows, and again, I mean, it wasn't that long ago. I mean, and this is my grandparents lived through the Great Depression. My dad was a Depression era baby. My mother was, right?
Hmm.
And so I remember stories from my grandparents and from my parents of what it was actually like to live through this,
Hmm.
and things like runs on the bank and other things like that, which it shows in that movie. And people don't realize the reason the banks are only open for very limited windows of time came about because of the Great Depression, right? The regulation said no, you can only open the banks for a certain period of time to help stop runs on the bank,
Runs on the bank.
because at
In
the
the days when
time
people had to make it to the bank
you had
physically
to
in order to be
physically
able
go
to,
into the
right.
bank and say, George Bailey, give me my money back. I
Hmm.
need my $20, right? And then George would have to pull out the cash and give you the cash. Now,
Sure.
we know in reality, right? So again, let's think about this from a physical perspective. Because there's this one scene in the movie where people come in on the run on the bank, and he tells him, he's like, folks, you don't know how a bank works. Joe, your $300 is not sitting in the vault.
Right.
Your $300 is in, Martini's house, right? How do you think we paid that? And when Martini pays us, right, then it's there. But if everybody in the bank comes in and says, give me all my money at the same time, it's not there.
Yes.
It's not there. Okay. We can understand that physically, right? But in a more automated, systematized, computer driven society like we're in now, you can have runs on the bank, and they can be much quicker.
They're
Because
actually,
again, when
yes.
a high wealth individual comes into the bank and goes, hello, I would like my $50 million back, please. They're not going to go count out $50 million. No, the person goes on their account and goes, $50 million gone, right? Now that $50 million is all electronic, but the $50 million is gone. And that $50 million is $500 million worth of loans.
Hmm.
because it's usually a 10-to-1 ratio.
Sure.
For any deposits, the bank can then put out those things. So again, just because it hasn't happened in a little while, don't kid yourself into believing that it won't happen again.
It's
Just because
very
we haven't had a Great Depression or a very serious recession for very long doesn't mean that we can't. I mean, 100 years ago, we had a lot of recessions before the Great Depression. People forget that.
this. I wanted to pick up on that point because several of your points that you're making on this slide are related in that way. In that, um, it's actually the opposite of what you would think. It's counterintuitive because we haven't had a bank failure in a while. It's actually more likely, not less likely, that because we keep as time goes by, we keep getting further out over our skis, right? We keep lobbying to say that we shouldn't necessarily have to be part of the same stress testing regulation as bigger banks, or we keep finding little ways to assume that these things just aren't going to happen anymore. They're not part of the new reality. You've talked, this is your rose colored glasses thing, but several of these points, it actually works the opposite way that you would think it does. That which you think makes you safer because you're in a new reality actually makes you completely less safe. Um, I wanted to
Yeah, and
highlight. Well, go
well,
ahead,
because I was
please.
going to
Yeah.
say, I think that is an important thing for people to understand, and one of those is going to flip them upside down.
Yes.
Is a lot of the real answers and a lot of reality are 180 degrees different from what you think it is. So we'll just use simple example, right? I'm a
Mhm.
middle-aged man. Now I've lived for a long time. So I can look
Right.
at it and say, well, geez, I've lived for so long. That must mean I'm going to live forever. And so I can look at this historical data and I can say, well, I've been around on this planet for decades. I'm going to be around for decades. When the reality is, right,
Hmm.
every day longer that I live, I am less likely to make it to the next day.
Yep.
And not to be morbid, because I'm going to live to be 150,
Right.
right? I mean, that's my intention.
Naturally.
That's my intention.
And you're only
But
29 right now,
I'm
so
only 29, so I've still got 121 years, right, or whatever that
right. You have the
math
beard of
ends
a
up being, right?
29-year-old. I mean, yeah, that's absolutely true. It's absolutely
Right.
true.
But you might laugh at this, but again, most people are thinking that way. I've lived for decades, so I'm going to live for decades. No, the
Yep.
reality is every day longer that you live, right, the higher the probability that something is going to happen that's going to take your life away. And so, we need to start thinking about it that way instead of that's through rose-colored glasses, right? As well. But
Hmm.
I know you were going to bring up
No,
other.
so one, maybe one or two other things that are just really worth highlighting on here. Because a lot of these are like bullet points, but they're also a way of life, right? So I'm stuck on that second one, the financial accounting
Mhm.
decision ones. That's a bullet, but that's a killer, right? So you were talking about you were getting into things like special purpose vehicles and being able to hide liabilities from one's master balance sheet. So that's what Enron was, right? And even to a lesser degree, there were a lot of energy related bankruptcies, major bankruptcies from like 2000 to 2010, I think, during that era of deregulation, because you had a lot of energy companies being set up not as energy companies, but as investment vehicles, right? You would take the energy company and then you would actually divide the energy company
Yep.
itself up and own it, not in a stock ownership way, but as a as a kind of a special purpose vehicle style investment asset. So,
Mhm.
but that, all of that was predicated that things like natural gas would remain in the price range that they would all the time, right? That's your rose-colored glasses again. So you have a combination of things going on with that. You have the misaligned incentives, treating everything as though it's an accounting exercise, right? You have the rose-colored glasses. The present state is going to get for the future, and by the time you leverage that out, which was the first bullet point you made, not only was that a catastrophe for the business, but of the surrounding ecosystem as well, the surrounding economy. So these things that I'm tempted to add that financial one to kind of the master list. It sort of falls under misaligned incentives, but the minute you start thinking that this, yeah, I absolutely agree, and that's so worth it. The minute it becomes an accounting proposition instead of an operational proposition, that's the minute you've traded everything away and you just don't know it yet, right?
Mhm. Well, and what's funny is, and again, I'll throw something out there that's going to be controversial for people as well, but publicly traded companies are always worried about what the market is, right? This is where the misaligned incentives come in, because I'll tell you, it's a secondary market. The market goes up or down. It has no real economic bearing on the company itself
Mm-hmm.
unless the company is planning to buy or sell its own security.
Mm-hmm.
Okay. In,
Yep.
in in reality, or unless it is promised to pay out dividends,
Options, that kind of thing. Sure.
options, things like that. Okay. And so honestly, if I put money out on the secondary market, I shouldn't give a shit what the investors get out of their money. That's between them and whoever's buying or selling their stuff, right?
Mm-hmm.
And it doesn't affect me economically, but where it does affect me economically is us being concerned about the wrath of the investors,
Mm-hmm.
right? Because again, if there isn't, if they can't, make their money back by selling to some other schmuck the investment that they put in there, so they get their money back, or we're giving them dividends, right? That they could be
Mm-hmm.
upset. And on the one hand, I don't care, except that they control the board usually, which means as a CEO, I could get fired if
Mm-hmm.
they're not happy. So here's where we've got these misaligned incentives again, too, right?
Yep.
Is that as a CEO, I want to keep the investors happy, which means I want to do everything and anything I can to keep that stock price going up,
Even when it's at cross purposes with your long-term
even
operating
if it's a
capability.
long term, right? And so I will jeopardize things currently, right? I will do things that make it look good to the market. I will jeopardize the long term success of my company for the short term interests of the vocal shareholders,
Yep.
which in my opinion is wrong. But
That's a huge one, huh?
at the same point, I will also manipulate the accounting because I probably get options. So you want to
Exactly.
talk about misaligned incentives, right? Is
Mm-hmm.
is as long as we continue to pay executives millions of dollars in things like options, they're always going to want to manipulate the accounting records. I'm
Exactly.
not saying commit fraud, some
But the
will,
incentive is going to be there.
but the incentive will be there to make not business decisions, but to make accounting decisions that will benefit me personally as the executive, will benefit the shareholders in the short term. Because honestly, if I'm a CEO, do I care what happens 20 years from now? Uh-uh. The tenure of a CEO, for the most part, is 3 years. What do I care? I'm going to collect my millions. I'm going to move on. At that point, who cares?
Right.
Right. So this is again where the accounting and the incentives really, really do kind of come in. But anyway, I know we've got a couple of other
No,
things
we've
that,
got about 10 minutes left, and I really want to talk about risk processes, which is on the
yeah,
which is what you brought next. So let's talk about that.
yeah. So when you think about what's interesting here is We talked about companies in general, but I think for risk management or risk management processes as well, here are some things that at the process or program level, whatever you want to call it, that really do make companies more fragile. One is the reliance on the data. And again, data, we should be looking at data. Data helps us to, reduce some of our cognitive biases, but I would say data creates a lot of cognitive biases when looked at incorrectly, right? And so again, we have to remember data is historical for the most part. For the most part, data is historical. And so again, if I look at the historical data of my age, I'm going to say, hey, I've already lived 50 some years, right? So I'm going to live another 50 some years, right? Why not? Because that's what the data is telling me. I've been around for that long. Well, but is that data reflective of what we think the future is going to be as well? Because that's another thing, right? Is if we expect the future to be different than the past, don't rely so much on the data, right? That's where you've got to earn your money by the art behind risk management instead of just the data, right?
Mhm.
But you talked about, things like the scale too, right? Is that as you scale, we have to think about things in a different manner. And this kind of goes back to the scale and the interdependencies that we talk about there are a little bit connected. Okay. Is that I think so much of the time when we're talking about risk management, we like to think that it's pretty simple. But the reality is, we live in a very complex world that is interconnected. And so, if people are familiar with the concept of system dynamics, this is what happens, right? This little thing happens over in this other part of the world, and all of a sudden it has an effect on this thing that seems to be completely separate, but is not over on this other side of the world, right? And so most people's minds don't think in a system dynamic way because honestly, our brain is set up to be linear. We'd like things to be linear where it is not from this standpoint. But think about, the bigger the scale, the more fragile you are. If you're the largest producer of whatever it is in the world, well, you're more fragile than the smaller person, right? Because when something happens to you, it has an effect out to everything. And so I have weights and measures on there as an example, right? Is that in the food industry, one of the compliance things we had to deal with was weights and measures, right? Some regulator in some state goes and buys our product off of the shelf in a grocery store and goes and weighs it. And they're like, you didn't put enough in there, right? Where again, normal variability, you would know that, again, the fill levels are not going to be exactly the same, but they're going to average out, right? So if I give you a container and it says it's 12 ounces, if it has 11.9 ounces in it, do you really care? If it has 12.1 ounce in it, do you really care? Maybe there's a variability of that on either side of it. And we would say, hey, look, on average, every can or jar of whatever this is has an average of 12 ounces. And that would be fine. But the problem is when you have things like weights and measures, they say, oh no, you can be over. You can put 12.1 in there. But if you put 11.98 in there, we're going to make you recall all of that. Now, all of a sudden, at scale, that's different. I'm not talking about 0.02 ounces. I'm now talking about potentially for us billions of pounds of product that could be recalled. That's scale. Okay. I have electric cars up there. And again, electric cars are great, great for the environment. But this is one of those interdependencies and scale kind of issues. And so, again, I just want you to kind of think through this in your head. In California, where I live, starting in the year 2035, you can no longer buy a non-electric car. Okay, they've already put that in the books, so everybody's scrambling to make electric cars. Great. Now, all of a sudden, let's assume that we have all of these people now driving electric cars. Where are they going to get the electricity to power it? They got to plug it in. Imagine what that's going to do to the electric grid when everybody now, instead of going to the gas station, is plugging in their car. The electricity's got to come from somewhere. Now, that's just one side of it. Think of everything in our society and economics that are driven off of fossil fuels. All those gas stations on the corner, those are owned by somebody. Right? My little mobile station here is owned by some little old gentleman. He's going to be out of business in a few years. Now, there'll still be some gas that'll be sold, but start to think about all of the different things in our economic system that will change and will be affected, some of it very quickly and very fragilely from a volatile perspective when some of these things actually come into place. So I think, the incentives we talked a little bit before about, and again, the interdependencies I tried to kind of show here with, I've got the auto versus pharma, and that's an interesting discussion that maybe we'll have to do. And I think we've got another topic kind of similar to this in the future.
Might be able to leverage that. Yeah.
Yeah, because that's going to be, it's a very interesting question that I pose to some people. What's riskier, the auto industry or the pharmaceutical industry? A lot of people knee jerk to one of them, but we can get into a lot more than that. But let's talk about over control on here, because I think this is probably a good way for us to kind of wrap up some of it, because
Sure.
I think a lot of times, we think that by controlling things, we we take out that volatility, we take out that uncertainty. And maybe you take out some of it for the smaller, repetitive kinds of things. But most of the time, and what I'd like people to start thinking about is how much are you giving up to be in that much control?
Right.
Okay. And so one of the chief risk officers that I work with, he's a client, do some coaching with him. They were looking at it, and he said, I'm looking at this area of our business, and I think we are over controlling. It's like, well, what do you mean? Well, we've set these limits kind of down here, and I think really we could probably increase our risk taking, by a little bit, but we would have a huge upside on it. Now, for a chief risk officer to go back to their company and say, let's take more risk, a lot of people are like, are you kidding me? I hired you to reduce the risk, right? But, again, did the analysis, looked at it and said, you know what? I think really we're excluding ourselves from a lot of business that we could be getting if we actually upped our tolerances a little bit and accepted some of these other kinds of clients. And so they're like, all right, let's do it. $200 million of extra revenue in a quarter.
That's an amazing outcome.
So
Yeah.
yeah. So I think that's like I said, I mean, I've got kind of, ways to be more resilient, again, just as kind of a wrap up, give up some control, right? Because like I said, I think for a lot of companies, there's a lot more upside too. Start making business decisions instead of accounting decisions. If you're over leveraged, start reducing that. Cash is king when you run a business. Accounting income doesn't mean a hill of beans. It's your cash. Is this something that's temporary or permanent? Don't ever try to put a permanent solution into something that is temporary. Think about your scale that you have, and check the data against your gut. But like I say, I'm a big proponent of check in with your gut. Don't just rely blindly on the data. because like you said, a lot of times the data can actually create more cognitive biases for you. And we've talked more about that, and I'm sure we'll be talking more about that in the future. But anyway, those are some thoughts that I had about fragility.
I appreciate that, Jason. Thank you so much for coming on and having this conversation with me. This is a topic that's obviously very fascinating to me. I hope equally fascinating to our audience. To our audience, thank you very much for spending some time with us today. If you signaled that you wanted to get CPE credit for this presentation, please watch your email inbox after we're done here today. You should receive an email with a couple of quick questions. Fill that out, return that to us. We will be back in touch with your CPE credit. My profound thanks to Jason Mefford for joining us here today. My thanks to all of you. We will see you here again for the next installment of Risk at Work. Take care.